Remember when everyone and their cousin was buying properties for Airbnb? Passive income, they said. Early retirement, they promised. Now, thousands of Airbnb hosts are panic selling those dream investments at massive losses. What happened? The short-term rental bubble, possibly the most predictable real estate crash of our lifetime, has finally burst, and the aftermath is transforming housing markets across America. The whole story started innocently enough. Back in 2008, during the last housing crisis, Airbnb launched with a simple idea: help regular homeowners make extra cash by renting out spare rooms. It was the genuine sharing economy in action. But somewhere around 2015, everything changed. Investors discovered they could make 2 to 3 times more money converting normal housing into tourist accommodations. What began as homeowners sharing extra space transformed into investors snatching up multiple properties solely for short-term rentals. Think about what happened next. In tourist-heavy areas, up to 20% of the entire housing stock converted to short-term rentals. 20%. Imagine if 1/5 of the homes in your neighborhood suddenly became unavailable to anyone actually wanting to live there. This wasn't just a few vacation homes changing hands. This was a massive extraction of housing from communities that needed it. The results were predictable. Studies show that in areas with high Airbnb density, long-term rental prices increased 10 to 15% faster than in comparable markets. Meanwhile, social media exploded with self-proclaimed gurus selling courses on how to build short-term rental empires. People with no real estate experience were suddenly taking out multiple mortgages, often with risky interest-only loans, convinced the good times would never end. Spoiler alert, they did. Communities didn't just sit back and watch their housing disappear. They fought back. Hard. Across America and Europe, cities began implementing increasingly strict regulations. Some required hosts to actually live on the property. Others limited rentals to just a few weeks per year. Many banned short-term rentals entirely in residential areas. The most aggressive cities created specialized enforcement teams using sophisticated data tools to hunt down illegal listings. Fines skyrocketed into the tens of thousands of dollars. And what's fascinating is that this backlash wasn't driven by hotel lobbies, as many assume. It came from ordinary residents watching their neighborhoods transform into tourist zones while their housing costs exploded. You could see the shift in public sentiment at town halls across the country. What once seemed like an innovative sharing solution was now being viewed as an exploitative investment scheme. With each new regulation, the financial math for investors got worse. Properties that once generated over $5,000 a month on Airbnb suddenly became legally limited to a fraction of that, if they weren't banned entirely. And then came the perfect storm. The short-term rental gold rush was built on 4 critical assumptions. 1. Tourism would grow forever. 2. Competition would remain limited. 3. Regulation would stay minimal. And 4. Interest rates would remain low. By now, all 4 of those pillars have crumbled simultaneously. Post-pandemic, tourism normalized, but the Airbnb supply had exploded. Listings increased by over 25% while demand grew by only 10%. Then interest rates doubled, even tripled. Investors who bought properties with adjustable rate mortgages suddenly faced payments thousands of dollars higher than they'd budgeted for. Consider this reality. An investor with 6 properties saw their monthly mortgage payments jump from $12,000 to $19,000 after rate adjustments. At the same time, their occupancy rates plummeted from 85% down to 34%. What was once a profitable business was now bleeding $7,000 every single month. The human stories behind these numbers are heartbreaking. Social media groups for Airbnb hosts transformed from celebration spaces to virtual support groups for financial distress. Posts about record bookings have been replaced with desperate pleas for advice on how to avoid foreclosure. According to industry data, average revenue per listing dropped 8 to 15% in most markets, while costs for mortgages, insurance, and maintenance increased by 10 to 30%. For many hosts, the math simply stopped working, creating a dramatic shift that's now reverberating through the entire housing market. But something remarkable is happening amid this crisis. Housing is returning to, well, housing. Long-term rental inventory has suddenly increased by nearly 10% across major markets, and the largest increases all in former short-term rental hotspots. The economics make this shift inevitable. A property that once generated $4,000 a month on Airbnb might now only make $2,500 with low occupancy. That same property as a long-term rental brings in $2,800 a month, with no cleaning costs, no turnover, no management headaches, and much lower risk. For renters, this is the first good news in years. After facing brutal competition for the few available apartments, renters in these areas now find themselves with actual choices and negotiating power. Rental agents report landlords offering concessions like free months or reduced deposits for the first time in years. Application numbers per available unit have dropped from double digits to just a few. This is particularly powerful in communities that implemented strong regulations. Some have seen their long-term rental inventory increase by over 40% within months. But this leaves a critical question. What happens to all those investment properties that no longer make financial sense? The short-term rental crash is creating three distinct outcomes. First, a wave of forced sales. Investors who are heavily leveraged and can't cover their mortgages are selling, often at a loss. Listings featuring phrases like former Airbnb or investment property have increased by 150% compared to last year. These distressed sales are starting to push down housing prices in former hotspots. Some tourist-heavy areas have seen median prices drop 8% or more, with properties sitting on the market 3 times longer. Second, we're seeing an amenity arms race. Desperate hosts still trying to make it work are adding hot tubs, game rooms, and Instagram-worthy features to stand out. But with demand so low, they're often spending thousands on improvements that will never pay off. Third, and perhaps most concerning, is consolidation. Large property management companies and investment trusts are buying these distressed properties at a discount from failing individual hosts. This mirrors what happened after the 2008 crash, when corporate buyers snatched up foreclosures from families. The Airbnb bubble didn't burst because of one single factor. It deflated due to a perfect storm of overexpansion, regulation, rising costs, and changing travel patterns. What's happening isn't the death of short-term rentals. It's a necessary correction. The market is resetting to a sustainable reality where housing serves communities, not just investment portfolios. For aspiring investors, this crash offers a timeless lesson. When an investment strategy becomes popular enough to inspire YouTube gurus and TikTok celebrities, the profit opportunity has already peaked. The Airbnb gold rush turned housing, something people fundamentally need to live, into a purely financial asset optimized for tourist dollars. The correction we're witnessing isn't just market forces at work, it's communities reclaiming their neighborhoods. And perhaps that's the silver lining in this financial storm. Houses are returning to their original purpose, being homes. If this video helped you understand what's really happening with short-term rentals, hit that like button and subscribe for more deep dives into economic trends that affect our daily lives. What's your experience? Have you noticed changes in rental availability where you live? Share your thoughts in the comments. And remember that market bubbles don't just shape investment returns. They shape our communities and the very places we call home.